Jack, really excited to have you today. Thank you for joining us. How'd you get into the real estate business?
Yeah, I've been in mortgage credit really my entire career. I was fortunate enough to grow up in Dallas, Texas. I ended up going to the University of Texas here in Austin. And right out of school, I guess in the late 90s, I went straight into the world of mortgage credit and structured finance at a Dallas based firm called Amresco. It was an amazing experience. You probably never heard of the company because they're no longer around, but super smart people, learned a ton. Unfortunately, in 1997, when you had the Asian financial crisis, quickly followed in 98 by the Russian debt default, and then long term capital blew up. We actually had about $1.4 billion of loans on a Lehman warehouse line. And that was my first introduction to what happens when you have large amounts of financing on a mark to market basis with the street. So, unfortunately, that was sort of the beginning of the end for Amresco, but I'd been extraordinarily fortunate because the company had, tentacles into residential real estate, commercial real estate finance, franchise finance, and all these different business lines. And I was sort of at the epicenter of it within the corporate finance group. And I had been able to develop some really good relationships with our street firms, our banks. And so as the company was sort of winding down, so to speak, I had the opportunity to move to the sell side, move up to New York, and get involved on the investment banking side, where I was working with or for Credit Suisse, First Boston, RBC, basically doing asset-backed finance and securitization work, primarily focused on mortgage credit related products. That's non-agency mortgage loans. Back in the early 2000s, we were doing a lot of manufactured housing loan deals and so forth. So yeah, that's really sort of the genesis and how I got into the business.
That's great. That's awesome. And then maybe, catch us up with, where you're at today, Palisades Group. We talk about kind of the private residential credit trends, what you guys are seeing and kind of how you guys kind of fold into this industry. That'd be amazing.
Yeah, so maybe it makes sense to tell you how I got to launching Palisades in 2012. So I was on the sell side for probably about 5 years or so. And I moved over to the buy side in 2005, working for a firm in Greenwich, Connecticut. It was basically we were buying subprime mortgage loans, securitizing them, and putting the subordinate part of the structure into our hedge fund portfolio. So that was, pre financial crisis. I ended up spending probably about 7 or 8 years working for two firms in Connecticut, doing pre crisis, buying the loans and securitizing them. During the crisis, I moved to a firm where we were buying basically distressed residential mortgage backed securities, sort of in the midst of the financial crisis, which was admittedly stressful at the time. But in hindsight, you could have used a dartboard to select those bonds and still probably made a lot of money in the process. But at the time, it was definitely seemed like it was dicey. And then, leading up to 2012, before starting Palisades, I was, the firm I was at, we were really one of the first entrants into the distressed residential loan market, really starting, I guess, in 2009. And yeah, in 2012, I finally decided to strike out on my own, left my job, got a temporary office in Norwalk, Connecticut. I think I went down and got me a Dell computer and started Palisades with my co-founder. And really what we were seeking to do at the time was really do things that nobody else wanted to do. I mean, the world didn't need another investment manager at that time, and trying to compete with a lot of the big guys really didn't make sense. However, residential mortgage loans, they're a world in and of themselves. And you're dealing with a lot of line items. There's a lot of infrastructure, a lot of complexity that comes along with it. And candidly, a lot of people just don't want to deal with it. So that was sort of the philosophy when we started the firm. And in the early days in 2012, 13, 14, folks wanted exposure to distressed residential loans coming out of the financial crisis, but they didn't want to build the internal infrastructure to manage, those portfolios. And that's really where we got our start, is providing a turnkey solution for managing large, complex portfolios of residential loans for private equity firms, insurance companies, groups like that. And today, we continue to do that business, continue to help, large institutional managers and insurance companies and so forth with their mortgage loan portfolios. But we also have a series of private funds that cater to, traditional allocators like uh, college endowments, foundations, and so forth.
Maybe we kind of want to talk to us a little bit about the loans that you guys are working with. Kind of the types of loans in particular. Maybe it's commercial real estate versus uh, uh, individual or individual mortgages. But kind of just maybe talk to us about some of the loans that you guys work with in general.
Yeah, that's a really cool thing about our space. I don't think a lot of people recognize is when people think about residential mortgage market, they think about like a 30-year fixed rate consumer loan. And, the US mortgage market is a $14 trillion market. Admittedly, the vast majority of that relates to Fannie Mae, Freddie Mac, Ginnie, and so forth. So agency government type product. But, we estimate that the private residential credit market is about a $3.5 trillion market. And within that $3.5 trillion market, there's just a multitude of different product types, risk, return, duration, credit, cash flow profiles from which to construct durable portfolios. So there's really everything from super high credit quality, like jumbo residential mortgage loans. And Mike, to answer your question very succinctly, we don't really deal with commercial real estate. We're focused, and nor do we really spend much time on like multifamily residential. The vast majority of everything that we're doing in our 17 plus $billion managed portfolio is related to single family. But within that, there's a high credit quality jumbo mortgages. There's distressed, non-performing delinquent loans. There's short duration loans to builders and developers. There's home equity products. So there's really just this whole wide variety of things that you as an investor can look at and really think about strategically and tactically in terms of how to construct a portfolio.
Yeah, I guess then maybe stepping into the kind of just the trends and what you guys are seeing within that subset of the market. Um, Given we're in 2024 here this year, kind of where are some opportunities? What are you guys looking to take advantage of?
Yeah, it's been a wild ride, I would say, over the last several years. That's probably not unique to our space, but there's definitely some very interesting dynamics that have taken place as in large part as a result of monetary policy, zero interest rate policy, and maybe it helps to kind of go back to that time frame. I mean, if you think about what's happened between what 20 late 2019, early 2022, there was $10.5 trillion worth of mortgage loans originated, either refinance activity or purchase money. And the average interest rate on those loans were like 3.5%. If you look at the entire universe of the US mortgage stock today, the average interest rate is 3.8%. And the average, 30-year fixed rate mortgage is, depending on which measure you look at, call it, seven and a quarter, seven and three eighths, something like that. So that has created a very unique dynamic within the residential housing market. And everybody's talked about, this lock-in effect. But essentially, what people were focusing on when rates were rising was the impact that rising interest rates would have on affordability, which makes sense. But also, as a result of lower levels of affordability, the demand destruction that would take place in housing. I think what everybody missed was the disproportionate impact that rising rates would have on the supply of homes, specifically in the resale market. And it's really a crazy, interesting dynamic because if you look at where we are from an inventory perspective today, resale or existing homes stand at about 1.1 million units. That's over 50% below the historical average of call it 2.2, 2.3 million units. And you know, when you look at what we call our supply demand parity indicators, things like month supply of existing homes, days on market for listed properties, owner occupied vacancy rates. If you move over to Census Bureau data, I mean, the new home market, you can track months to sale since completion of new homes. All of these things really create this mosaic that tells you really across the country, we're seeing excess demand relative to supply. That's actually why we saw home prices increase in 2023 by over 6% in a rising interest rate environment. So it's really bizarre and somewhat counterintuitive, but it's all driven by decisions related to monetary policy. Now, in terms of opportunities, I think it depends on who you are as to whether or not this market creates opportunities or it's in distress. If you're a real estate broker, this is a horrible market because, housing transactions are down. But if you're a builder or if you're an investor, there's a lot of interesting opportunities that can be derived from this odd or unique environment that we're in today. And, from a builder standpoint or even from, a credit investor's perspective where you're financing, new construction, that's a really interesting space right now because we can finance, new single family home construction in a market that's undersupplied with housing. And the interesting thing about these loans is they're generally short duration. So they're like 12 to 24 months on average, or closer to 12. So they're short duration. You're not taking a lot of interest rate risk. There's multiple draws over the life of the loan and so forth. And that creates this operational complexity component to the product. So you're dealing with like high yielding loans. There's not, the competition and price risk is diminished due to the operational complexity. So you're able to get higher absolute yield, short duration. And you're typically dealing with a professional builder on the other side. So, like I said, there's some interesting opportunities. Home equity, we have $30 trillion of home equity in the market today. And when you think about a lot of these homeowners who have built up this equity, they have first lien mortgage loans that call it 3.5% interest. They don't want to lose that mortgage, but they want to tap into their equity. That really creates opportunities for, some of these equity extraction products, closed end second liens, or home equity shared appreciation contracts, or things like that. There's definitely some interesting opportunities, but there's also some head scratching, things going on in the housing market for sure.
Absolutely.
I think that's helpful. I guess, you mentioned interest rate risk. I mean, mitigating risk in a portfolio, given just the different market dynamics. I'm just curious how you guys view that from your lens, and what different levers do you guys pull that are unique to your perspective of how you handle your business?
Yeah, I mean, risk is interesting in our business because we are credit investors. I think a lot of the folks who invest in private residential credit, that they consider themselves credit investors. So we're not looking to take views on interest rates, so to speak. I mean, we
Right,
try to hedge out the duration risk in our portfolio. At the end of the day, we're credit investors. And
right.
the really cool thing about, managing portfolios of residential loans, and I'll compare and contrast that to like being an investor in mortgage-backed securities, for example. But residential loans, you get full transparency. The borrower's name, their situational profile. If there's a hardship, you're fully aware. If you make right party contact, you get to understand what their hardship is. You get to tailor, structure, bespoke workout solutions. It can be a very hands-on, active management approach to optimizing outcomes during workout, scenarios. So when we think about risk, we really think about asset level risk management, whether that's asset level at the borrower, the loan, the property level. And now you compare it and the other thing that we have from full transparency, we actually have the house address. We can look it up. We can assess, our view of value, and that all of that information really feeds into how we try to optimize outcomes for homeowners. And at the end of the day, we're always looking to keep homeowners in the house. We've got mounds and mounds of data. I think we probably manage over $32 billion of loans, probably close to $10 billion of delinquent and distressed loans. And I can tell you that going through foreclosure and eviction is the absolute worst outcome for community, for the borrower, the neighborhood, and ultimately, for the investor capital that we're managing. So it's really um, an effort in trying to figure out how to keep the asset cash flowing, keep borrowers and the homeowners in the home. But when you move over and compare and contrast that to maybe a mortgage-backed security strategy, folks are going out buying securities at different parts of the capital structure within a securitized non-agency transaction. You know, they aren't getting the same level of transparency. They don't see the property address. They don't have the ability to step in and be part of the workout optimization process. And look, there's more liquidity there. There's reasons why mortgage-backed securities are, part of a diversified portfolio. But just from a risk management standpoint, the ability to really control, workout scenarios is, I would argue, within the residential whole loan market, it's almost like no other credit space out there. I mean, you could argue that non-bank corporate lending, by the end of the day, like we're dealing with land, real estate, building structures as collateral, and all those things, you can kind of move levers up and down on all these different, elements. Whereas if you're dealing with like non-bank corporate lending, oftentimes you've got like depreciating receivables, IP and, cash flows and things like that.
Yeah, that makes a lot of sense. It's really cool how you guys are looking into all that information. Like, where's the house located? How's the borrower doing? On that note, could you kind of talk to us about how you guys go about sourcing these loans?
Yeah. So sourcing is really dependent upon, the types of loans that we're buying. In the early days, back in 2012, 13, 14, when we were focused almost exclusively on distressed residential loans coming out of the financial crisis, those would get sourced from like bank relationships, the folks who own the loans, and those trades would be, hundreds of millions of dollars would trade in a single package. Fast forward to today where really the distressed opportunity set has dissipated. I don't think we bought actively a distressed or delinquent mortgage loan since probably, 2019, I would say. So a lot of our involvement in the market today is newly originated loan products, and those are sourced from originators across the country. So we've got a network of originators of all different product types that we've put the pipes in place with over the years. And depending on, what preferences are with respect to geographic locations, product type, whether it's a construction loan or a home equity product, or whatever the case may be, we have resources and partners that originate those, and that's how we're sourcing today. The one thing I would also say, Mike, on that topic is, you know, from day one, we've always sought to take a very sort of hands-on approach to risk management. So we're not we try to internalize everything that we possibly can. So when we're thinking about, sourcing, whether it's in a large portfolio package or whether it's a one-off where we're just buying on a flow basis from an originator, you know, we are not providing counterparties with this like credit box and say, hey, if you guys can originate to these specifications, we'll buy whatever you can originate. We will give our partners, feedback with respect to what our risk tolerances are, what our preferences are. And then, once they close the loans, they'll show them to us. And then we will basically re underwrite them. If it's a construction loan, we're going to look at, you know, project feasibility. Are they buying or building, I should say, a 10,000 square foot house in a neighborhood surrounded by 2,500 square foot homes? Does the developer have proper experience in this market? What does the loan structure look like? And once all those things are signed off on, then that's when we give it the green light and buy into the portfolio.
Yeah, that's really cool. Are you guys? Do you kind of take it like maybe you talk to an originator and they give you a list of, let's say, like, just throwing some out here, like 20 mortgages that they just closed. Are you kind of going through that and saying like, I want number one and number 10, or do you kind of just take the whole package?
No, we're doing exactly what you were talking about. We'll say we'll take number 1, number 10. I mean, at the end of the day, we're in the business of deploying and managing capital. So we are incentivized to try to find good investments. We're not, at the same time, we're risk managers at the end of the day. First and foremost, we're here to preserve capital and then secondarily generate a return on that capital. And so I will say our team is very diligent in terms of, determining what we will buy. But at the same time, like, we're not trying to kick out. If we get 10 loans, we're not trying to kick out nine of them. We'd love to take all 10 if we can.
That makes sense. No, that's great.
On that topic, too, you want to be a good partner. And so these originators, at the end of the day, they are our partners in all of this. And so if they show us 10 loans and we take one, they're probably, not going to view us as a great partner. You know what I mean? So there's a whole lot of, I mean, this market, and one of our sort of core values that we talk about internally is access through reputation. We get access to the market. We get access to these different product types by virtue of the reputation that we and the standards that we uphold for ourselves. And that's a lot different than if you're trading a fixed income book where you're trading, bonds off mid list, T plus two, or maybe it's T plus one now, something like that. Um, so yeah, it really is important to be a good partner. So it goes back to like, you don't want to enter into a trade with somebody, and then you get into diligence, for example, and be known as counterparty that's cherry picking the portfolio or just not acting right. And you always come across those, folks out there, but I feel like in our space, they don't last as long as they may in other markets.
Yeah, that makes sense. Obviously, being a good partner, having a great team, that's important. I always say just the three things of people, process, and technology. You mentioned you have complete transparency, which is great. I'm sure it's a huge differentiator in what you're looking at for opportunities. How do you manage this whole process given just all the different loans? I mean, from a technology, from a data perspective, there's a lot going on. I'm assuming you have a great process, and then I'm sure there's technology you use around that, which is probably helpful too.
Yeah, I don't think, most people appreciate the amount of infrastructure that's required to manage effectively tens of thousands of mortgage loans. And I will say this, maybe I'm not giving people credit enough. This business historically, managing residential loans, has historically been very manual process where in many cases, if not the vast majority of cases, key credit related decisions have been outsourced to mortgage loan servicers. And one of the things that, I think that we've done rather well over the last dozen years is really started to bridge the divide between that historically manual process to where we are today, where we're using data management capabilities, and proprietary technologies to really drive efficiencies in process as well as drive asset level credit decisions. And so, but I will tell you, Skylar, it has not been without extreme pain over the years. I mean, basically our enterprise data warehouse, which we started day one, um, it basically houses all the information for all the loans that we've ever managed. Life of loan, we're getting daily feeds from all of our mortgage loan servicing partners on twice a day. We're downloading it into our systems. And, that's great. For years, we had this database, but people like me couldn't access any of the data. You know what I mean? I'd have to go ask one of our programmer guys who knows SQL to write a script, give me a report, and all that stuff. We tried licensing third party tools, and it just never worked well for us because we do manage different product types. If you're just dealing with like one type of residential loan, then, maybe some of these third party systems would work. But today we manage over 49,000 individual loans for 48,000 across 12 different product types. So the
Wow.
system has to be very flexible. Today, our enterprise data warehouse has over 40,000 rows of code. And we've ended up building, a series of applications that sit on top of the data and, like I say, sort of drive efficiencies in process. And the one thing I would say too is, like, if you had asked me, I don't know, back in 2012 or really throughout most of my career, said, what is your edge? And I've always sort of erred to the quantitative side of the business. I would have said, we've got this whiz bang cash flow model that does all these simulations and we can hone in on the price of a loan. all this good stuff, home price appreciation forecast, interest rate forecast, all this stuff. And, you fast forward to today, that's really just in our view, a price of admission. Like if you're in this space, you have to know how to price loans and you have to, yeah, I mean, you just have to have a model. And so when we sit down, we actually have a technology demo with a prospective investor a little bit later on today. We really don't even touch on our valuation model. What we are focusing on are the tools that help our asset management team make good asset level credit decisions. We focus on the tools that help our collateral team because nobody thinks about what is collateral in the mortgage world. Your title policy, your assignment of mortgage, your security instrument, your note, all these different things. And when you're trading these things, documents get lost. And so that can have a big impact on the economics if you go to sell the loans, if you have to exercise your rights as a lien holder. So these are the tools that we really spend time focusing on and trying to show people that this is where you add value in this strategy. It's not like pricing up the loan day one.
Yeah. Let's dive into the technology aspects a little bit more. You mentioned a lot of the things that you guys are looking at with technology, but kind of give us an overview of, maybe the technology side of the business, kind of the platform as a whole, kind of how you use it and what you're looking at.
Yeah, well, it all starts with the data set. And, probably the most valuable, and there could be debate on this internally, but the most valuable part of our technology is our data management capabilities. And what I mean by that is, you have as a mortgage credit investor, if you're dealing with multiple servicers, and I think we're dealing with over 2 dozen different mortgage loan servicers in our portfolio, we're getting all of this data coming in on a nightly basis. They all have different field names, different data dictionaries. And so, that 40,000 lines of code is basically there to take on all of this data, understand what the different fields mean, normalize it into something that is usable for our team. And, hopefully this example will make sense, but like understanding property value is fundamental to the strategy, right? It's a collateral for the loan. And so you think, well, that's easy to figure out what the property value is, right? You probably have an appraisal, or you may have a broker price opinion, or you may have an electronic valuation that you ordered from some vendor. Well, the question is, if you have an appraisal and you have an automated value that came out of a model, which one are you going to use? Well, if you have an appraisal that's 6 months aged, you'll use the appraisal. But the appraisal 6 years aged, you'll have use the model value. So there's all these different waterfalls that have been created on not just property value, but all these different key metrics. So that at the end of the day, if somebody on our asset management team needs to understand, okay, we have a distressed borrower. We need to understand what their situational profile is. We need to understand what the house is valued at. So they have that data that's readily available and accurate. So that's where everything starts. You can't like make decisions without good, complete, and accurate data. And then, I would go back to, we'll talk about hardships and communication with borrowers. So historically, the way that mortgage loan servicers work, let's say if I default on my loan, I'll call you up as my lender and say, "Hey, I just lost my job. I'm hoping to get a new job. I probably won't start for 2 months. I don't have the money for my mortgage payment, and I have like a couple months of payment holidays or something like that." Well, that type of dialogue doesn't fit nicely within to like different fields that would come and fit into a database. What basically is happening, you're going to be as my lender, you're going to be sitting there typing into the system, borrower lost job, or you may use, shorthand like BRWLSTJB. So it's like unstructured text. And so historically, the way that people have gone through they're called servicing notes or collection notes, you'd have a swarm of people who would go back and you say, okay, you look over the last 12 months or the last 24 months or whatever, and then you would just manually type in what your findings were for that particular loan. That's just a horribly inefficient process. And So I don't know, 2015, 2016 timeframe, we started building what we call Story. And Story is a pretty cool tool, and I probably won't do justice in explaining, how it operates. But essentially, it takes all these unstructured text comments, and it has used machine learning. It just has learned over time. A great tool at some point, I would think, for AI to get involved. And we've got initiatives to sort of look into AI to build on top of this. But to be candid, it's basically just going over thousands and thousands of these and having individuals sort of, highlight these unstructured text phrases or words. And it has created what I think probably 110, what we call insights. It just gives you information about what's going on with a loan, a property, a borrower, whether they lost their job, if there's property damage, what's going on with the insurance, if there is property damage, just gives you all these insights that you just can't get from standard fields that we receive from servicers. I could go on, but there's other technologies. But I mean, the point is you can see that there's a lot more that goes into this than just like valuing a loan. If you're really trying to manage risk at the asset level, optimize outcomes, having this data and having systems that will allow you to do it efficiently at scale is mission critical. I will say in this environment, though, I think that's missed on a lot of people because today, with home prices increasing at 6% year over year, with unemployment where it is today, there's just not a whole lot of distress or defaults in the market. And so it's what you would expect. You'd expect like new entrants to come in, they buy up a bunch of loans, don't have the infrastructure necessarily to manage these portfolios. I do think, to the extent that we entered into a recessionary environment, we're already seeing, as you know, some cracks in credit card utilization, credit card delinquencies, auto loan delinquencies. I don't envision, seeing widespread defaults in the mortgage space, at least in the near term. But, certainly around the margins, you are seeing delinquencies. And at the end of the day, that I think can be a big separator in our space. People who have the ability, experience, and capability to sort of handle, you know, workouts and those who don't.
Yeah, 100%. Yeah, I like the thought. I mean, I'm just obviously there's a lot of moving pieces. Being able to be agile and elastic with what's happening in the market with technology, with the right data and the great team that you have. I think that's definitely key, right? To be able to move quickly and be nimble and take advantage of opportunities as they come your way in real time.
Yeah. I mean, the one big thing I kind of alluded to it is AI. When you have this monstrous data set, I think it's right for artificial intelligence solutions. One of the big things that we're struggling with is like in our database, we have, you know, consumer information, social security numbers, phone numbers, all that kind of stuff. And so we've had to create policies internally from a compliance standpoint such that, nobody uses, the AI tools and puts our data into it. But, as that space develops and we start to see, solutions that will ring fence data, I think that could be extraordinarily powerful for our space. I think not only for what we're doing on like the story side of the equation, but just like asset management in general. I mean, you could envision a world where our asset management team comes in at 8 or 9 o'clock in the morning and they have a full blown report generated by AI where it's dictated here are the watch list loans, here to the new watch list loans, or then here's activity that took place with the watch list loans that
Mhm.
were there yesterday, and then here's sort of the path, the recommended path for all of these. It'd be a really interesting world, but I do think we're a little bit ways away before, actually see.
Yeah, definitely. I think there's a lot of opportunity there. Just even just what I'm seeing too in the marketplace. I would say too, even just having that knowledge base internally that's in real time. I think most people make business decisions on a lag,
Yeah.
a quarterly lag, right? But be able to have that in real time, you can definitely see kind of what your business is doing up to the minute, which is I think is going to change a lot of things for a lot of people how they make decisions going forward, right?
Yeah. We have an investment in it's like a home equity shared appreciation contract. And so it's basically a product that gives homeowners the ability to tap into the equity in their home without having a monthly principal and interest payment. So basically, it's like a investment in the home alongside the homeowner. It gives us exposure to owner occupied real estate as opposed to like a single family rental portfolio where you have exposure to tenant occupied real estate. Just a cool product, but the whole like one of the big drivers of performance is payoff activity. So I've got this report up on my screen. It's up on my screen pretty much 24 hours a day. And I can see anytime that a payoff gets posted, I can see that it gets posted. I see what the proceeds were. I see what the value of the home was. I compare the value of the home relative to what we thought value was at our last quarterly valuation committee. And so it's really cool to have this real time insight into data because I think to your point, Skylar, if you're a bond investor, if you invest in mortgage backed securities, you typically get reports on the 25th day of the month. And that report on the 25th is for the prior calendar month. So, it's 25 days delayed. And,
Right.
you know, and not to mention like you, and if you do get that information as a bond investor, there's not a whole lot you can do about it other than call the servicer or something like that. But
Yeah.
Right.
Yeah.
Yeah.
Technology side's very fascinating. Yeah, a lot of things I never even thought about there. Um, I want to kind of change the subject a little bit in terms of very curious to learn about what type of investors, LPs do you guys typically work with, and kind of how do you see it real estate? How does it fit into or real estate, credit lending in terms of how does it fit into a portfolio of these LPs?
yeah, it's a good question. I mean, so we deal with two parts of our business. Obviously, we have our private fund side, and then we have, where we're working with insurance companies and private equity firms. On the private fund side, it's really the traditional limited partners that you would expect: college endowments, foundations, family offices, health systems, and pensions and things like that. I would say it's really interesting and it may be interesting is the wrong word, perhaps, interesting and frustrating at times. Like, if you're a traditional high yield, you know, manager, that fits very nicely within like a fixed income allocation. Private residential credit, that's all over the place. We see private residential credit end up in hedge fund portfolios and pension funds or endowments. We've seen it be housed within the real estate group. We've seen it housed in the private credit group. And so it's really, I would say if you were talking to one of our business development fundraising people, they would tell you, it could be tough trying to navigate and figure out where the strategy actually fits. And it also depends on the product. Like I would say, some family offices are very sensitive to, the tax profile of investment strategies. And if you're dealing with like distressed non-performing loans or loans that you're buying at a deep discount, would you have a reasonable component of the return attribution allocated to capital gains. Whereas if you're buying newly originated loans at par or a premium, your return is going to be more ordinary income. So you do see, on the family office side, some, tax sensitivities. But the interesting thing about our space today is I don't think that it requires a big sell to LPs that private credit is an important part of a broader diversified portfolio. I I will say most allocators, when you mention private credit, are thinking about direct lending or non-bank corporate lending. They're not thinking about private residential credit. And, you know, there's been a lot of capital raised for private credit or direct lending, in part due to rising interest rates, in part due to private equity exits have slowed down. So a lot of private equity firms have sort of pivoted and started raising private credit funds. And, I would argue that there's a fair amount of competition that is now coming into that space with all the capital that's been raised. You see some of the big banks coming back into the space, Goldman, JP. So I think a lot of the excess return over time will be possibly competed out. And and if not, excess return competed out, certainly some of the protections that a lot of the direct lending groups tout may end up not being as good as they had hoped given some of the competition. So when we talk about, where does private residential credit fit within a portfolio, we try to, in today's world, fit it into the private credit bucket. But private credit is like a $1.5 trillion market. The private residential credit is like a $3.5 trillion market with all these different product types as we've discussed. So I would make the argument that if you have a private credit allocation, the vast majority of that should be private residential credit that's collateralized by land and real estate and structures and things like that, where direct lending would be more of a, you know, ancillary add-on to that core real estate debt component. But I'm not sure if everybody would agree with me.
Think that makes a lot of sense from the collateral standpoint.
Yeah, I think people really miss that. I mean, at the end of the day, yeah, home prices can go down. We get it. If you're building a new home and you think it's going to be worth 400,000 and you're wrong and it ends up being worth 350,000, yeah, that can obviously impact a lender's collateral, ultimately impact their ability to get paid back. But at the end of the day, I mean, you're dealing with notwithstanding the global financial crisis volatility, you're really dealing with an asset that everybody needs. It's in today's world is in vast undersupply. So look, that could change in the next 24 months and we could be sitting here in, call it 2026 and we have excess supply relative to demand. Home prices are going down. But, my view is in the grand scheme of things, having something tangible that you can touch and feel as collateral and something as important as individuals' homes, I think it makes for an important component of a investor's portfolio allocation.
Absolutely.
Yeah.
How about on the side of risk? What do you think of as some of the, maybe biggest risks to the market, and what do you guys kind of do to mitigate those risks?
Yeah, it's a really good question, and I wish I had like great answers because the things that like keep me up at night deal with insurance risk because certainly in the coastal areas, property insurance is going through the roof. A lot of insurers, are moving out of certain states like Florida and California. So that's something that definitely keeps us up at night because that starts to make into affordability decisions. And then the other part is just like natural disaster risk. I think in many respects, our flood um, risk mapping is well out of date, and I don't think that we have, across the country, proper flood insurance for um, homes across different property markets. So that's definitely something. I think we wrote a report on that a couple of years ago just highlighting that risk. So it really does require our team as we're doing underwriting to look at like if it's a new construction, like where is this being built? Is there proper insurance? Is a consumer who's going to buy this in product when it's all built? Are they going to be able to get insurance? Is it going to be astronomical relative to the overall housing costs? Um, so those are 2 things that are front and center. The other thing that is, you know, not necessarily directly related to portfolio performance, but it's definitely something that is concerning is cybersecurity. We've seen a couple of large mortgage originators. We saw a huge mortgage loan servicer all report cybersecurity breaches, and these are groups that are using some of the most sophisticated technologies to prevent cyber attacks. And I was talking to one of the guys at one of these firms, and he was telling me it's not a matter of if, it's just a matter of when. If they want to get in, they're going to get in. And so when you're dealing with like consumer information, like we are, that's definitely something that, we're extremely focused on.
Yeah. 100%. Obviously, it's
Uh,
big issue.
One more thing, and this is kind of anecdotal to like what's going on in the housing market today. And we actually probably wrote about this in like a March report that we posted on our website. But everybody's talking about pent up demand today. And I think like the Fed has really backed themselves into a very tight corner with respect to inflation and housing. Number one, housing is such a large component of both CPI as well as PCE that, you know, when the Fed lowers rates, let's say, lowers rates 50 basis points. Well, what is that going to do? That's going to release pent up demand into what we've discussed as being an already undersupplied housing market. So that's going to, further perpetuate housing inflation. So that's going to be a problem. The one thing that nobody is talking about, and I kind of understand why, but there's also this concept of pent up deferred sales. So there's a lot of folks out there who have 3.5% mortgages. Maybe their kids are gone off to school, like mine, candidly. Both of my girls are in college now. So it's just my wife and I. Do we really need the house that we have? Probably not. Do we like cleaning the house? Probably not. But we're not going to give it up because we've got a 2 7/8 mortgage. That mortgage is a real asset today. And so, but there is this concept of pent up deferred sales. So at what point in time and at what level of interest rates do people like me, who have a low mortgage, but we don't necessarily want to stay in our house, capitulate and say, okay, we're willing to suck it up and put our home on the market? We won't, it's not at a 7.25% interest rate, probably not at a 6, but at a 5.25%, a 5, that starts to like, you can wrap your arms around that. You know what I mean? And I do think if we were to have some events that require the Fed to lower rates considerably, like call it 200 basis points, you would have a couple of things happen. In some housing markets, you would find supply demand parity, which I think would be very much welcome. I think in other markets, you would have excess supply relative to demand. So as we think about, sort of longer term positioning in a portfolio, I think those are some of the things that, they may be further out than most people want to look at, but I do think it's important to think about because it's a real dynamic in the housing market where you do have people who are, wanting to leave their home, but or list their home for sale, but they just aren't going to given where rates are today.
Yeah, definitely. And Jack, what you just described it explained my situation perfectly from my
Yeah.
from what's in today. Like it is, yeah, like it's 5.25. Okay, because exactly right. Everybody's holding on to these low interest rate mortgages, and they don't want to. They find a great opportunity, but then they don't want to pay, 7, 8%.
Yeah.
But is it 6? Is that okay, or is it 5.25? Like, what's the happy medium? What are we comfortable
Yeah.
with a new mortgage?
Yeah. We're living out in the boonies right now because when we relocated to Austin, we wanted to be in a certain school district. Now our
Yeah,
girls are gone and I'm traveling 30 minutes for work. I'd love to just my wife and I get a nice little condo downtown where all the fancy restaurants are and all that stuff, but
yeah.
just not going to do it.
I've even seen Jack just talking to some of my real estate friends who are basically saying a lot of folks sometimes are just carrying the mortgage and to the new homeowner because they have that lower interest rate and they're going to hold on to it and just have just a private sale. And I've seen some of that happening now recently. So yeah, it's a great point and great insight there that what you bring up is what's happening today.
Yeah, how cool would it be if we could assign our mortgages?
I know
That would be pretty neat.
that would be pretty neat. Yeah. Thanks
Or
for
take them with us or assign them or whatever.
yeah. Yeah, absolutely.
Definitely.
But
Let's talk a little bit about your market outlook. Curious, Jack, just to see, what do you see coming down the road, whether it's, rate hikes or, uh, anything in particular. I think you touched on some really good points like the insurance, potential like natural disasters, but, what's your market outlook going forward?
yeah, unfortunately, for a lot of the folks and even some people in our office who are looking to buy homes today, I really don't see like the supply demand parity developing anytime soon. Certainly not this year. I think mortgage rates will likely remain elevated alongside monetary policy. As a result of elevated rates, I think you're going to continue to see what we've been talking about, sparse resale inventory, which, I do think that creates a very interesting environment for the home builders. In some cases, they're almost the only game in town, and they certainly have a competitive edge with respect to resale because they can reallocate a portion of their incentives budget to buy down the mortgage rate for a prospective buyer. Um, but like I was saying, I think any mile, like I think after today's and yesterday's CPI report, you know, people are anticipating a cut in September or a cut in December, September or December cuts. And, anytime you have a cut, I think what like small drips and drabs like that, I think the initial inclination is going to be if the mortgage rates dip down, that you'll have this pent up demand into an undersupplied housing market. So I think you're going to continue to see housing inflation over the course of, certainly this year, if not going into 20. So and it's tough because, I think housing represents over 40% of CPI. I think it's 15 to 20%, something like that, of PCE. So the Fed's really they've got a tough job. They really do. Unfortunately, I think they're the ones who created the problem for themselves, but they really do have a tough job in terms of trying to rein in inflation and lower rates.
Yeah, like you said, Jack, earlier, they backed themselves into a corner at this point in time. It's a tough thing to get out of where we're at right today.
Yeah, and it's tough too. I mean, you kind of look and you can see it. I'm sure you guys know some younger folks out there. I mean, there's just this divide, almost like the haves and the have-nots. The people who owned a home back in, 2021 or something, or bought a home, or they refinanced their home. Now their housing costs are, mortgage debt service to disposable income, is at historically low levels. But then you flip over to the people who are still renting, didn't buy a home, typically, folks in their 20s, 30s, they have student loan debt, whatever the case may be. Now their housing costs are variable, their rent, continues to increase. It's from that perspective, I mean, that's different than just the investment environment, but just like the impact that it's having on real world individuals is kind of sad, if not frustrating. And, I think one of the big keys is to try to get affordable housing, onto the market. But then you've got land costs, you've got construction costs. It's hard for a builder to construct a 1,500, 1,700 square foot home profitably, So as we think about ways to like, bring supply demand parity down, bring housing access to affordable housing, whether it's, rent or buy, I think there's a lot of things that we need to do from a policy perspective to try to encourage that type of development or incentivize that type of development.
Yeah, great point. Absolutely.
But one more thing that's on my mind is I wanted to talk to you guys about duration. Kind of how do you think about duration in your portfolio and in cash flow management?
Yeah, that's a good question. So, like from a duration standpoint, it really depends on the type of product mix that we have. So, as I mentioned earlier, we're not rates guys, and we don't try to, take views on rates. We try to position our portfolio in a way that somewhat insulates us from too much rate risk. So our policy is we try to keep a portfolio duration of plus or minus 1 year. And so there's ways that we can address that on the asset side. We should buy short duration, like construction loans that are like point 0.7, point 0.8 year duration assets. So, you're not taking much rate risk there. And then you can also allocate to mortgage servicing rights, which, provide an offset. They're negative duration asset. And then, you can use derivatives, interest rate derivatives to hedge out some of that interest rate risk. In cash management, treasury management, I'll tell you, that's tough. That part of the business. That's when we talk about like operationally complex products. Like a construction loan is an operationally complex product because you really do have some fairly intense treasury management requirements because you may have a builder who sends you a disbursement request and they need to pay their subs and contractors. And if it takes you a week to turn that around, then people are sitting around, the project isn't moving forward. He may lose some of his, some of the labor, and so it's really important to have cash on hand and have a process in place where you can make review inspection reports and confirm that milestones have been achieved, but then get cash to the developer so he can pay his subs as quickly as possible. And that's why you see like some people just don't want to deal with that for a point 7, 0.8 year duration asset that you're constantly having to like recycle proceeds. And so it's a situation where you really do need to have the infrastructure to be able to deal with. And look, we're fortunate to be able to have that infrastructure. I wouldn't try to replicate. Like if I was walking around the street, I say this sometimes, but if I was walking around the street today trying to figure out what I wanted to do with my life, I would not try to, recreate Palisades today. I think there's less stressful things that could be done, but it is a fairly operationally intense strategy, that's for sure.
Absolutely.
We got a great team too, who credit goes to them. They've really built an amazing process and machine.
Absolutely. That's great.
Cool.
Yeah, no, this has been great, Jack. Great. We appreciate the conversation. Thanks for jumping on. Where can people find you? Reach out.
Yeah, we have a website. So you can go to www.palisades.us.com, and that has all of our market insights on there. It's an overview of the firm and, contact information that you can contact us there. We post stuff on social media, LinkedIn primarily. So find us in any of those venues.
Amazing. We'll make sure to include those in the show notes. This has been great. We appreciate the time, Jack.
Yeah. Thanks so much, Jack. Really appreciate it.